Every year, the African tech ecosystem absorbs $4 billion in venture capital. It's a massive influx of wealth flowing into early-stage innovation. At the exact same time, the global diaspora sends over $100 billion back home annually in remittances. These are two massive pools of capital operating in the exact same geography, yet they pass like ships in the night. Imagine a successful professional living abroad. They have $20,000 in savings, deep knowledge of their home market, and a strong desire to back local founders instead of just sending cash for consumption. They approach a top-tier venture fund to invest. The door immediately slams shut. To even sit at the table, these funds demand minimum checks of $200,000 or more. Because that threshold is so high, the wealth generated by local tech companies is captured almost entirely by foreign institutions. The community is left to consume the technology, rather than own the infrastructure that produces it. You might be wondering why our professional doesn't simply bypass the fund and write that $20,000 check directly to a startup as an angel investor. The answer lies in the harsh reality of the venture capital power law. In emerging markets, roughly 90% of early-stage startups fail due to macroeconomic volatility, currency shifts, or infrastructure deficits. If you only have the capital to back 3 or 4 individual companies, you are statistically guaranteed to lose your entire principal. The risk is mathematically unacceptable. Venture capital relies entirely on extreme outliers, the 1 or 2 companies in a portfolio that return 50 times their initial value. Catching that single outlier requires spreading capital across dozens, sometimes hundreds of different startups. Extreme diversification is the price of admission. Only the volume of an institutional fund provides the statistical coverage necessary to survive the early-stage failure rate. To fix this, we have to look at the fund managers themselves. They aren't setting these massive minimums out of malice. They are trapped by 3 structural walls. The first wall is regulation. Governments enforce strict securities laws to protect retail investors, legally barring those without a high wealth threshold from private markets. The second wall is a rigid headcount limit. Under rules like the Investment Company Act, a private fund faces severe operational penalties if it accepts more than 99 investors. This creates the denominator problem. To raise a $50 million fund, 50 million divided by 99 seats means the average investor must write a $500,000 check. Accepting your $20,000 check consumes a slot, forcing the required average for the remaining 98 investors to immediately spike higher. The law forces fund managers into an economic corner, incentivizing them to reject middle-class professionals. The third wall is the sheer physical friction of processing human beings. Adding a single person requires identity verification, anti-money laundering checks, complex quarterly tax reporting, and individually chasing down capital calls. A venture team has to pay lawyers and accountants to manage all of this. That administrative burden can easily cost a fund between $5,000 and $10,000 a year per investor. When you run the numbers, taking a $20,000 check doesn't just complicate the cap table. The administrative friction causes the fund manager to actively lose money on the transaction. We cannot easily rewrite international securities law. We can, however, change the legal architecture we use to navigate it, using a tool called a master special purpose vehicle. A community index fund acts as a legal wrapper. Thousands of small checks fuse into a massive legal entity. This solves the denominator problem, occupying one of the 99 seats on the fund's cap table. It also eliminates administrative friction. Capital aggregation is the ultimate legal loophole. It allows fragmented, everyday investors to disguise themselves as a single, highly desirable institutional giant. This concept of pooling capital is not a new invention born in Silicon Valley. Communities across the African continent have used indigenous economic structures, like stokvels and tontines, to successfully aggregate, protect, and deploy local capital for centuries. We are simply taking those ancient investment-grade trust networks and placing them onto modern legal tech rails. Aggregating these flows pulls billions out of passive, fragmented remittances and puts that capital to work as productive, compounding anchor capital. The hurdle isn't a lack of capital, it's a lack of organization. When pooled with discipline, a community